In 2019, Cineworld was, well, there's a machine that printed money.
Right.
I mean, they were a $4.8 billion titan of the entertainment industry, selling hundreds of millions of tickets across the globe.
They had completely conquered Europe.
Yes, conquered Europe, swallowed the United States, and they were standing on the precipice of finalizing a colossal acquisition that would crown them the absolute, undisputed kings of North American cinema.
They were an empire, essentially.
They were. But then, precisely 3 years later, their stock was worth literal pennies. I mean, their market capitalization had just evaporated.
Completely wipes out.
The empire was handing the keys of its castles directly to its lenders in a United States bankruptcy court.
Which is just a staggering reversal.
It is.
Right.
And you are about to embark on a deep dive into an investigative autopsy of one of the most spectacular corporate collapses in modern history.
A complete structural failure.
Exactly. We are examining the trajectory of Cineworld Group plc today. This is peak to dust.
And our subject today, they rapidly consumed their way to becoming the second largest theatrical exhibition business on the planet.
Only to be crushed by the immense compounding weight of its own ambition.
Right. And this is not a story of a gradual, gentle decline due to changing consumer tastes.
No, not at all.
It is a study of exponential, aggressive growth followed by an immediate, catastrophic failure.
So, to understand a failure of this specific magnitude, we cannot rely on hindsight or narrative spin.
No, we have to rely entirely on the empirical record.
Right. Our analysis today is grounded strictly in the evidentiary foundation left behind by the entity itself.
And over the course of this investigation, we will be dissecting their official annual reports and accounts from 2018 through 2021.
We will also be examining their real-time trading updates and scrutinizing the press releases that announce the multi-billion-dollar acquisitions of Regal Entertainment Group and Cineplex.
And most crucially, we will analyze the devastating named legal ruling from the Ontario Superior Court of Justice.
That specific case, Cineplex v. Cineworld, it basically served as the final anvil dropped onto the company's glass foundation.
It really did.
So our investigation is structured to follow the anatomy of this disaster from peak to dust.
Right, so the first half of our analysis will exclusively examine the dizzying ascent of Cineworld's power.
And the highly aggressive financial architecture they built to sustain it. We will document precisely how they achieved global dominance.
While the second half will dissect the catalysts of its rapid decline.
We will look at a fatal cocktail comprised of a global pandemic, crushing leveraged debt, and, well, a catastrophic legal defeat.
To really understand the mechanics of what happened here, you have to think of Cineworld not as a traditional movie theater company selling popcorn and tickets.
Right.
Think of them as a financial supernova.
A supernova.
Yeah, in astrophysics, a supernova expands rapidly by burning highly volatile fuel.
And for Cineworld, that fuel was leveraged corporate debt.
Exactly. What you will discover today is what happens when a star expanding at that velocity suddenly violently runs out of oxygen.
That analogy of the supernova is structurally accurate. Because in corporate finance, rapid expansion fueled by debt creates a massive, inescapable gravitational pull.
Right. The sheer gravity of the interest payments dictates every single move the company makes.
Everything must perfectly align to sustain the structure.
The cash flow must be uninterrupted.
Because if the revenue stops, even for a moment, the mass of the debt causes the entire entity to collapse inward on itself.
That is the physics of leverage.
And that is precisely what we are going to trace through their financial records. But before we can analyze the peak, we have to understand the origin and the methodology of their ascent.
The trajectory begins fairly modestly, actually, in 1995.
Right. Steve Weiner founded Cineworld.
Yes, and a year later, he opened a single multiplex cinema in Stevenage in the United Kingdom.
It is a humble beginning for what would become a global monolith.
It is, but from that single multiplex, the trajectory points steadily and aggressively upward.
Because by 2004, the private equity firm Blackstone acquired Cine UK, which led to a merger with UGC under the Cineworld brand.
And that institutional backing fundamentally changed their DNA.
It did. It culminated in 2007 when Cineworld was formally listed on the London Stock Exchange.
Which is a massive shift. They transitioned from a private enterprise to a public vehicle requiring constant growth.
That transition to the London Stock Exchange is really the critical first inflection point.
Absolutely. Because going public demands a growth narrative to satisfy shareholders.
Right. And this initial phase established a clear, unyielding behavioral pattern.
The company realized very quickly that it could not be content with slow, organic growth through incrementally higher ticket sales alone.
Because selling a few more tickets each year does not impress the market.
No, it doesn't. Their chosen methodology was systematic acquisition. They became a machine designed to swallow competitors.
And we see this accelerate significantly in the subsequent decade. In 2012, they acquired the Picture House chain of cinemas.
Right, which was a strategic move to bring an art house premium brand into their portfolio, effectively expanding their demographic reach.
But the true shift in scale, the moment the ambition became international, arrived in 2014 with the massive Cinema City combination.
Let us examine the mechanics of that 2014 Cinema City deal, because this is where the scale of their operations begins to truly warp.
Right. Cineworld acquired the entire issued share capital of Cinema City, holding from its major shareholder for £272 million in cash and consideration shares.
And on a debt-free, cash-free basis, this represented an enterprise value of £503.4 million.
Which is huge. I mean, this wasn't just buying a few theaters.
Not at all. This single transaction added 99 multiplexes and 966 fully digital screens.
Across Israel and 6 Central and Eastern European countries.
Overnight, with a single signature, Cineworld became the second largest cinema business in all of Europe by screen count.
And if you look closely at the financial impact of that single transaction on their balance sheet, it's wild.
Oh, it's dramatic. During the 2014 fiscal year, the Cineworld Group increased its net assets by £312.4 million to a total of £506.3 million.
Even more revealing, its operating profit increased by 102.7% compared to 2013.
But beyond the mathematics, the Cinema City deal was a vital cultural fusion.
Because it brought the Greidinger family into the executive structure of Cineworld.
Exactly. And the Greidingers were cinema royalty, essentially. They had started the predecessor to Cinema City way back in 1929.
Right. And Luki Greidinger, who would eventually become the CEO of the enlarged Cineworld Group, was deeply entrenched in the industry.
This integration fused a highly ambitious, generations-old cinema family with the massive capital access provided by the London Stock Exchange.
It created an executive culture that viewed aggressive expansion almost as a birthright.
And that momentum carried them rapidly into 2016, which the documents show as a year of immense milestones.
Total revenue hit £797.8 million.
And for the first time in their history, they passed 100 million annual admissions.
Furthermore, they acquired 5 Empire Cinema sites, which included the highly iconic Empire Leicester Square in London.
Right, for £94.5 million, which was settled equally in cash and ordinary shares.
This vastly increased their presence in the heart of London, which is an area where they had historically been underrepresented.
And their net assets increased by another £128.9 million to £663.4 million during that year alone.
But I want to challenge you on this, because buying companies requires massive amounts of capital.
It does.
How exactly is a theater chain generating the hundreds of millions of pounds required to execute these takeovers? What was the underlying architecture funding this growth?
It is critical to dissect the specific method of this growth. It was not funded solely from the cash register at the concession stand.
Right, obviously not.
No, it was achieved through the aggressive, highly sophisticated use of mergers and acquisitions architecture.
Meaning what exactly?
Meaning, Cineworld utilized a combination of what we call rights issues and multi-currency revolving credit facilities to swallow these regional competitors whole.
Okay, let's translate those terms for the listener, because when we talk about a rights issue, we are essentially talking about asking existing shareholders to double down, correct?
Yes. A rights issue is an invitation to existing shareholders to purchase additional new shares in the company, usually at a discount.
So it's a way to raise hard cash quickly.
Exactly. For instance, the cash consideration for the 2014 Cinema City deal was part funded by an 8-for-25 rights issue.
And that raised net funds of £107.2 million.
But a rights issue rarely covers the whole bill. The residual cash for these massive acquisitions comes from debt.
Right.
Specifically, they utilized a new 5-year debt facility that included term loans of £165 million and €132 million.
And a revolving credit facility acts similarly to a massive corporate credit card, right?
That's a good way to put it. The company can draw from it, pay it down, and draw from it again as needed to fund operations or smaller acquisitions.
So they were systematically leveraging both equity and debt to purchase market share.
Yes, continuously.
Beyond the external acquisition strategy, though, The internal strategy, what they were doing inside the physical theaters, was equally aggressive.
It was. The source documents detail a heavy, deliberate focus on what they termed premium
Right,
offerings.
they actively expanded IMAX installations, eventually becoming the operator of the largest number of IMAX screens in Europe.
They also aggressively rolled out 40x 3D super screens and VIP auditoriums.
By the end of 2017, they operated 35 IMAX screens and 38 40X screens. But why invest so much capital into expensive seating and giant screens when a standard theater already plays the film?
Because those premium screens are not merely customer perks, they are vital financial levers.
Right.
The theatrical exhibition industry has a fundamental flaw. It is highly dependent on the quality of the Hollywood film slate.
The number of people who want to go to the movies fluctuates wildly based on whether Disney or Warner Brothers releases a cultural phenomena or a total box office bomb.
Exactly. So to insulate themselves against these unpredictable admission volumes, exhibitors must maximize the revenue extracted from every single individual who walks through those doors.
Because they cannot control how many people come, but they can control how much those people spend.
Precisely. Premium offerings like IMAX and 40X command significantly higher average ticket prices.
And this strategy directly increases a core industry metric called box office per patron, or BPP.
Yes, and we see this exact same philosophy applied to the concession stand.
The sources note a deliberate expansion of food and drink offerings. They didn't just sell popcorn.
No, they forged major partnerships, opening 29 Starbucks-licensed coffee outlets inside their theaters by the end of 2017.
They also increased their VIP auditoriums, which feature expanded menus and licensed lounges for alcohol sales.
Which drives the second critical metric concession per patron, or CPP.
By increasing both the box office per patron through expensive premium screens and the concession per patron through enhanced high-margin food and beverage options, Cineworld was architecting a revenue model that could generate record profits even if overall theater attendance remained entirely flat.
It was a highly sophisticated, calculated strategy to extract maximum yield from their physical footprint.
But let us subject this initial European strategy to intense scrutiny. On paper, it looks brilliant.
It does.
But was this a sustainable business model, or was it simply a corporate game of Pac-Man?
Pac-Man.
Yeah, in Pac-Man, if you stop consuming, you die.
Ah, I see.
If your primary engine for asset growth is buying other companies using revolving credit and asking your shareholders for cash through rights issues, you are entirely dependent on the assumption that capital will always remain cheap and accessible.
That's true.
And you are assuming that every company you swallow will instantly generate enough cash to pay off the debt you took on to buy it.
You have correctly identified the defining tension of highly leveraged growth. This strategy is undeniably effective during periods of macroeconomic stability, low interest rates, and strong market confidence.
And we must acknowledge that their early execution was flawless.
It was. The CinemaCity combination was objectively successful. The financial documents explicitly state the synergies achieved significantly exceeded original expectations.
But there is a deep psychological danger in that success, isn't there?
Absolutely. The danger is that this early success validates the methodology. It trains the executive board to believe that scale solves all operational problems.
Right. When you successfully digest a £500 million acquisition and the stock price goes up, the corporate appetite naturally seeks a target exponentially larger.
The board begins to view debt not as a risk, but as a guaranteed vehicle for continuous growth.
Which brings us to the moment where the ambition breaks containment.
The tipping point.
Right. They have conquered Europe and the formula works. But the problem with a strategy reliant on debt-fueled growth is that you have to keep feeding the beast.
And by 2017, the only meal big enough to satisfy Cineworld was across the Atlantic.
This marks the transition to the absolute peak of their power. On December 5, 2017, Cineworld announced the proposed acquisition of the United States-based Regal Entertainment Group.
And the terms of this deal were staggering.
Cineworld offered $23 per Regal share, valuing the equity at $3.6 billion, with an implied enterprise value of $5.8 billion.
To place the sheer audacity of this deal into context, we have to look at the scale of the target. Regal was not some regional chain.
No, Regal was the second largest cinema chain in the entire United States.
They operated 561 cinemas with over 7,300 screens across 43 states.
And Cineworld, at the exact moment they announced this buyout, operated just over 2,200 screens.
The acquirer was fundamentally attempting to swallow an entity vastly larger than itself.
It is the corporate equivalent of a python swallowing an alligator. Why take such a monumental risk?
Because of the prize. The stated rationale in the acquisition documents was to create a globally diversified operator and gain unfettered access to the North American market.
Right, because the United States possesses the largest industry box office in the world.
Exactly, consistently generating greater than $10 billion annually since 2008.
If Cineworld wanted to dictate terms to Hollywood studios and dominate the global exhibition market, they had to own America.
And when the acquisition officially completed on February 28, 2018, the footprint of the enlarged Cineworld Group exploded into a true monolith.
By the end of 2018, the combined entity was operating 9,518 screens in 790 sites across 10 countries.
They had officially achieved their goal. They were the second largest cinema operator in the world.
And the peak 2018 financial indicators reflect this massive, sudden injection of scale. Pre-tax profits skyrocketed by 125% to $349 million.
Total revenue soared 259.1% to a staggering $4.12 billion.
The broader market's reaction to this scale was, well, it was euphoric.
The valuation of the company followed the revenue trajectory. The stock price surged on the London Stock Exchange, eventually reaching a massive high of 221 pence by late 2019.
This valued the company at roughly £4.5 billion, or approximately 4.8 billion US dollars.
They were a juggernaut generating immense cash flow. In 2019, revenue remained exceptionally strong at over $4.3 billion, with profit reaching $475 million.
And overall admissions hitting 275 million individual patrons globally.
275 million tickets sold.
It is an empire of unparalleled physical foot traffic.
It really is.
But as investigators, we have to look beneath that $4.3 billion in revenue. We have to examine the subterranean financial architecture supporting this $5.8 billion buyout.
Right. How exactly did a European operator with 2,200 screens secure the funding to purchase an American giant worth nearly $6 billion?
The source documents reveal it was funded by the proceeds of yet another fully underwritten rights issue,
which this time raised $2.3 billion.
alongside a newly restructured massive debt arrangement.
And that debt facility is the critical component of our autopsy.
Let's break it down.
To finalize the Regal acquisition, Cineworld secured a US dollar and euro term loan totaling $4.1 billion, plus a $300 million revolving credit facility.
To secure this kind of syndicated loan, which is essentially a massive loan provided by a group of lenders who pool their capital to share the risk, the board had to commit to strict financial covenants.
Yes. Specifically, they targeted a leverage ratio for the enlarged group of roughly 4.0x net debt to pro forma 2017 EBITDA.
We really need to unpack this carefully for the listener, because the term EBITDA and a 4.0x leverage ratio are the absolute core of why this company eventually collapsed. Let's translate this financial mechanics into reality.
Okay, so think of EBITDA earnings before interest, taxes, depreciation, and amortization as the raw cash the movie theaters generate from selling tickets and popcorn before the taxman, the banks, or the accountants take their slice.
It is the pure operational cash flow.
Exactly. And if a company has a 4.0x leverage ratio, it means their total net debt is 4 times larger than that raw annual cash flow.
And to understand the peril of that math, you have to look at the margins. Operating at 4.0x leverage leave almost zero margin for error.
None. A massive, unavoidable portion of your operating cash flow must be immediately and continuously diverted just to service the interest and principal on that $4.1 billion debt.
So to justify this extreme leverage to their shareholders and lenders, the Cineworld board banked heavily on achieving an estimated $100 million in annual pre-tax combination benefits.
And in corporate terms, combination benefits mean cost savings from firing redundant staff, consolidating supply chains, and merging the two entities' corporate structures.
They also factored in an additional $50 million in expected benefits from the U.S. Tax Cuts and Jobs Act.
Yeah.
They assumed total operational perfection.
But they were also heavily reliant on external variables entirely outside of their control.
Right, because the incredible 2018 financial results were not just the result of brilliant management.
No, they were driven by a historic run of immense studio blockbusters.
The top grossing films of that year included Black Panther, Avengers, Infinity War, Incredibles 2, and Jurassic World. Fallen Kingdom.
In the U.S. segment alone, box office revenue represented 60.5% of total revenue.
And that is the vulnerability hidden in plain sight.
The underlying existential risk of this multi-billion-dollar debt load was masked by Hollywood delivering an unprecedented streak of billion-dollar films.
When a cultural event like Avengers, Infinity War pulls in hundreds of millions of dollars in the domestic box office, the theater operator generates the massive, immediate cash flow required to meet those stringent debt covenants.
The financial architecture Cineworld built was perfectly designed for optimal conditions, but it strictly assumed a continuous, uninterrupted supply of highly profitable global blockbusters.
And here's where the architecture looks fundamentally unstable. They mortgaged the future of the company to buy the present.
They absolutely did.
To service a 4.0x leverage ratio, Cineworld wasn't just relying on their own internal management execution. They were entirely dependent on Hollywood never having a bad year.
Never having a bad year, never having a strike, never having a disruption.
Did they just ignore the systemic risk? Did they look at a $4.1 billion debt load and simply believe they were too big to fail?
It seems that way. They controlled 75% of the UK market. They held a massive, dominating US footprint.
They built a global empire, but the foundation was highly leveraged paper. If revenue dipped even 10%, that 4.0x leverage ratio would spike immediately, violating their covenants with the banks.
It is a profound demonstration of financial hubris. The board's internal documents explicitly stated they were targeting leverage to return towards a safer 3.0x net debt to EBITDA by the end of 2021.
They were banking on strong, continuous cash generation to drive a material deleveraging profile.
They genuinely believed their sheer scale, their operational best practices, and the expected $150 million in run rate synergies would allow them to outpace the crushing interest of the debt.
The critical fatal flaw in their risk assessment was timeline.
Yes, their deleveraging strategy required at least 3 years of uninterrupted peak global performance.
They left themselves exposed in a window of extreme vulnerability.
Which brings us to the moment of fatal overreach.
By late 2019, they are carrying the massive $4.1 billion debt from the Regal acquisition.
The sensible corporate move would be to pause, digest the acquisition, and aggressively pay down the debt.
Instead, on December 15, 2019, Cineworld enters into an arrangement agreement to acquire Cineplex for 34 Canadian dollars per share in cash.
And Cineplex was not just another chain, they were Canada's largest cinema operator, possessing an overwhelming, near-monopolistic 75% market share in the country.
The terms of this deal implied an enterprise value for Cineplex of 2.8 billion Canadian dollars, which translated to approximately 2.1 billion US dollars.
This transaction was designed to add 165 cinemas and 1,695 screens to Cineworld's portfolio.
The stated objective was no longer just scale, it was absolute global dominance.
Because following the completion of this Canadian deal, the enlarged group would have operated 11,204 screens globally and a combined 8,906 screens across the United States and Canada.
This would have made Cineworld the absolute, undisputed leading cinema operator in North America.
But to fund this takeover, they secured commitments for a new $1.8 billion short-term senior unsecured term loan facility, plus an additional $0.3 billion short-term loan.
We must pause to dissect the strategic psychology of the boardroom at this exact moment in late 2019.
It's vital. CEO Mookie Greidinger and the Cineworld leadership were actively pursuing an additional $2.1 billion in debt to swallow a Canadian monopoly, while still deeply levered from the $5.8 billion Regal deal finalized just 22 months prior.
This represents the absolute apex of their expansionist philosophy.
It is the unwavering, perhaps irrational belief that acquiring market share and extracting operational synergies could mathematically outrun any debt servicing issues.
They projected approximately $130 million in annual pre-tax combination benefits by the end of 2021 if they absorbed Cineplex.
They were doubling down on the exact same strategy that bought Regal.
But the sources indicate there was a specific lucrative reason they wanted Cineplex that went far beyond just adding more movie screens.
Yes, they were looking for a hedge against the volatility of the movie business.
Cineplex possessed a highly developed amusement and leisure business.
The Cineplex operational documents reveal a highly diversified revenue stream. They operated massive entertainment locations under brands like the Rec Room and Palladium.
They also owned an amusement solutions business called Player One Amusement Group, or P1AG.
And in 2019, Cineplex's amusement revenues reached a record $228.2 million.
These non-exhibition businesses contributed approximately 20% of the entire Cineplex Group revenue.
Cineworld's internal documentation explicitly noted that this specific business operated in a sector poised for long-term growth.
It attracted millennials and Generation Z with experience-based entertainment arcades, dining, virtual reality that did not rely on whether or not Hollywood released a good movie that weekend.
So the acquisition makes strategic sense, but you have to consider the terrifying timing of the execution.
It is December 2019. They are standing at the absolute summit of their power, controlling over 9,500 screens, finalizing a $2.1 billion acquisition to secure a North American monopoly.
But they have effectively built a monolithic skyscraper on a foundation of credit, right as a global earthquake is gathering off the coast.
What does this tell you about their enterprise risk assessment?
It tells you they modeled perfectly for market dominance, but they did not model for a zero revenue event.
In fairness to their analysts, traditional corporate risk assessments account for severe economic downturns, a poor year of Hollywood films, localized competition, or changing consumer habits.
Right. They almost never account for a synchronized, global, government-mandated cessation of physical human gathering.
However, Cineworld's risk assessment was entirely reliant on the perpetual, uninterrupted motion of physical foot traffic.
When an entity is carrying over $4 billion in debt and attempts to stack another $2.1 billion on top of it, they surrender all margin of safety.
They engineered a company with zero tolerance for systemic disruption.
Which brings us to the breaking point. The supernova has run out of oxygen. We are now transitioning strictly to the decline.
In March 2020, the global earthquake struck.
Government mandates related to the COVID-19 pandemic ordered the immediate closure of cinemas worldwide.
Cineworld, the second largest cinema chain on Earth, closed all 787 of its cinemas across 10 countries.
The physical foot traffic, the absolute lifeblood required to service their billions in debt, dropped instantly and violently to zero.
The financial devastation was absolute and immediate.
The 2020 financial collapse is starkly detailed in their annual reports. Global revenue plummeted an astonishing 80%, falling from over $4.3 billion in 2019 to a mere $852.3 million in 2020.
Consequently, they reported a staggering $3 billion pre-tax loss for the year.
And crucially, this included $1.34 billion in asset impairments.
We need to make sure the listener understands the gravity of that term, asset impairment. It sounds like an accounting technicality, but is a massive red flag for a dying company.
It's essentially acknowledging a permanent loss of value.
Right. Imagine you buy a house for $1 million, expecting it to go up in value. But a toxic waste dump opens next door. The house is still there, but it is only worth $200,000 now. On your personal ledger, you have to write down an $800,000 loss, even though you haven't sold the house.
For Cineworld, $1.34 billion was wiped off their books in a single year.
They had to formally admit to their shareholders that the paper value of their empire, the goodwill, the leases, the brand value they had spent billions acquiring was drastically permanently impaired.
You are watching a giant bleed out on paper.
And to stop the bleeding, management initiating desperate mitigation efforts.
Executive directors voluntarily deferred payment of their full salaries and bonuses.
They furloughed the vast majority of their global workforce, leaving thousands without income.
They suspended all dividend payments to shareholders, completely halted new capital expenditure programs, and scrambled to the debt markets to secure $360.8 million in additional emergency liquidity just to survive the immediate closures.
But securing another $360 million in debt to pay off the interest on the previous $4 billion in debt is the definition of a death spiral.
It is. Here we see the fatal vulnerability of Cineworld's highly leveraged business model exposed.
To understand the economics of theatrical exhibition, compare a movie theater to a commercial Boeing 747 airplane.
Whether you have 2 passengers on that flight or 200, it costs the airline almost the exact same amount of jet fuel, pilot salaries, and landing fees to fly the plane.
A cinema is a massive, fixed-cost operation. Even when a theater is closed by government mandate, the company must still pay the commercial leases on the physical buildings.
They must maintain the projection equipment.
And most crucially, they must pay the compounding interest on billions of dollars of debt.
When a retail store closes, they stop buying inventory, which saves money. When a cinema closes, the costs remain, but the revenue goes to zero.
The debt does not pause, it accelerates the depletion of cash reserves.
That fixed cost burden is why the 2020 and 2021 financial reports begin referencing going concern warnings.
And a going concern warning is not a casual legal disclaimer.
No, it is a stark, formal realization mandated by auditors. It means the company is legally required to warn its investors that without a massive reopening of the box office and a rapid return to normalcy, the entity could fundamentally cease to exist.
They were acknowledging that they might not survive their debt covenants.
As we analyze their survival tactics, it is deeply illuminating to contrast Cineworld's fate with its primary rival in the United States, AMC Entertainment.
Right. AMC was also severely impacted by the pandemic and carried significant crushing debt loads. But they survived. Why did AMC live while Cineworld filed for bankruptcy?
Because AMC experienced an unprecedented cultural and financial anomaly, the meme stock phenomenon.
During the pandemic, retail investors on platforms like Reddit aggressively bought AMC stock in a coordinated effort, driving the share price up to completely irrational, astronomical levels, disconnected from the company's actual fundamental value.
AMC's management astutely capitalized on this anomaly. They utilized this massively inflated equity valuation to issue new shares to the public, raising billions of dollars in hard cash.
They effectively deleveraged their balance sheet through retail equity.
They turned internet hype into survival capital.
But Cineworld did not have a populous escape hatch.
Exactly. Cineworld was a traditional, institutional, corporate entity listed on the London Stock Exchange. They were heavily reliant on traditional institutional debt and syndicated loans from major banks.
They could not mean their way out of the crisis.
They were bound by the strict, unforgiving mathematics of their leverage ratio and the demands of their corporate creditors.
As the pandemic dragged on, pushing vital, high-revenue movie releases like the James Bond film No Time to Die back repeatedly, the math for Cineworld became increasingly terminal.
But the pandemic was an external shock. It was a force majeure. Let us look at the self-inflicted wound that accelerated the end.
In the midst of the 2020 lockdowns, bleeding cash every day, Cineworld was still legally bound to complete the $2.1 billion acquisition of Cineplex in Canada.
And on June 12, 2020, Cineworld sent notice that it was formally walking away from the arrangement agreement. They pulled the plug.
Cineworld alleged that they were terminating the agreement because Cineplex had breached a number of its covenants.
Specifically, they claimed Cineplex failed to operate in the ordinary course of business between the signing of the agreement in December 2019 and the closing date.
This aggressive action triggered an immediate and ferocious legal retaliation.
Cineplex sued Cineworld, claiming up to 2.18 billion Canadian dollars in damages for repudiating the contract.
This resulted in a massive legal battle before the Ontario Superior Court of Justice. In December 2021, Justice Barbara Conway handed down a devastating named ruling.
The court completely rejected Cineworld's arguments.
Justice Conway granted Cineplex's claim, entirely dismissed Cineworld's counterclaim, and awarded Cineplex damages of 1.236 billion Canadian dollars for lost synergies, plus an additional 5.5 million for lost transaction costs.
We must do a deep dive into the legal mechanics of this ruling because it exposes the immense peril of complex M&A contracts during global crises.
Why did Cineworld lose this case so disastrously?
To understand the ruling, we must analyze the architecture of the arrangement agreement itself. Like most massive corporate buyouts, it contained a standard material adverse effect, or MAE clause.
An MAE clause is a risk allocation mechanism.
It generally allows a buyer to walk away from a deal if the target company suffers a catastrophic, unforeseeable change that destroys its value before the deal closes.
However, as is common in highly negotiated contracts, the MAE clause contains specific carve-outs events that do not count as a material adverse effect.
In this contract, the MAE explicitly excluded an outbreak of illness.
Meaning the risk of a pandemic was contractually allocated to the buyer.
Therefore, Cineworld could not legally use the COVID-19 pandemic itself as the reason to break the deal.
They signed a contract saying, essentially, even if there's an outbreak of illness, we still have to buy you.
Precisely. Because they were legally barred from using the MAE clause, Cineworld's lawyers had to find another exit.
They chose to argue that Cineplex breached the interim operating covenant, the requirement to operate in the ordinary course of business prior to closing.
Cineworld pointed out that during the government-mandated lockdown, Cineplex drastically altered its operations.
Cineplex deferred payments to landlords, they delayed payments to film studios and suppliers, and they reduced capital spending to the absolute bare minimum to conserve cash.
Cineworld argued this severe deviation from normal daily operations breached the contract.
But the court's response to this defense was definitive and highly analytical.
Justice Conway ruled that reacting to a government-mandated shutdown by deferring payments and managing liquidity was the ordinary course of business for a company navigating an unprecedented crisis.
The judge stated that Cineplex's response was entirely consistent with measures it had used to manage liquidity in the past during smaller downturns.
And that they were commercially reasonable efforts to maintain the business while theaters were forcibly closed by law.
Justice Conway wrote a particularly damning assessment of Cineworld's motivations.
In the ruling, she stated, the reality is that the economics of the deal did not change because of the deferrals and spending reductions. It was the pandemic that changed the economics of the transaction.
Because of the pandemic, Cineplex was no longer the attractive deal to Cineworld at $34 per share that it had been.
Cineworld is attempting to use the operating covenant as a means of circumventing the very risk that it assumed.
The judge saw entirely through the legal maneuvering.
Cineworld simply could not afford to buy Cineplex anymore, and they were using a technicality to escape a contract that had become financially lethal.
The financial implications of this ruling were impossible for Cineworld to absorb. The judgment awarded 1.24 billion Canadian dollars, which translated to approximately 950 million US dollars.
Consider the scale of that penalty.
At the time of this ruling in late 2021, this single damage award of nearly $1 billion was significantly more than Cineworld's entire market capitalization.
The penalty was worth more than the company itself.
And there is a profound, bitter irony in how those damages were calculated, isn't there?
There really is. The court rejected Cineplex's argument that they should recover the lost premium payable to shareholders, which is the standard way these damages are calculated.
Instead of awarding the lost shareholder premium, Justice Conway awarded damages based on the lost synergies that Cineplex would have realized from the merger.
To determine the value of those lost synergies, the court looked directly at the pre-transaction reports, financial models, and synergy projections prepared by Cineworld's own advisors when they were hyping the deal to their lenders.
The court calculated the $1.24 billion figure using Cineworld's own optimistic math.
Cineworld was truly hoist by its own petard. The very financial models they aggressively built to justify taking on more debt to acquire the company were used by a judge as the exact mathematics to penalize them for abandoning it.
So, as analysts, what does this legal debacle tell us? Did Cineworld's executive board know they were legally trapped, but chose to break the contract anyway because closing a $2.1 billion deal during a global pandemic would have bankrupted them immediately that week?
Was this a calculated gamble?
Did they decide to trade a lethal bullet today for a lawsuit tomorrow?
From an analytical standpoint, examining the timeline and the cash flow constraints, it is highly probable that breaking the contract was a calculated, desperate delay tactic.
If Cineworld had proceeded to close the Cineplex acquisition in June 2020, they would have been forced to draw down nearly $2 billion in new debt, precisely when their global revenue was practically zero.
That would have triggered immediate insolvency and a violation of all existing covenants.
By aggressively breaking the contract, they guaranteed a massive lawsuit.
But a lawsuit across international borders takes years to litigate. They bought themselves time.
They were gambling that the pandemic would end quickly, theaters would reopen to record crowds, the blockbusters would return, and they could generate enough cash to either settle the lawsuit out of court or absorb the eventual damages.
But time ran out, and the crowds did not return fast enough to save the math.
We arrive at the final phase, the dust, the crushing debt, and Chapter 11.
Let us look at the final grim financial ledger as the year 2021 closed.
Despite revenues recovering somewhat to $1.8 billion in 2021, largely thanks to a massive performance by Spider-Man. No Way Home, the structural damage inflicted over the previous 18 months was terminal.
The balance sheet was horrific and completely unsustainable. By the end of 2021, their net debt had climbed to $4.84 billion.
But it is worse when you look at the total obligations. If you include their massive lease liabilities, the contractual requirements to pay rent on hundreds of massive physical theater buildings across the globe, the total debt burden was an astronomical $8.9 billion.
Against this towering mountain of obligations, their restricted cash on hand was a mere $345.4 million.
They were carrying $8.9 billion in liabilities on pandemic-depressed revenues, with a billion-dollar Canadian judgment hanging directly over their head like a guillotine.
The final steps to bankruptcy play out in 2022 like a slow-motion architectural collapse.
In August 2022, Cineworld issued dire liquidity warnings to the market.
They formally admitted that admission levels since reopening were significantly below expectations.
They blamed a weak late summer film slate, citing a lack of blockbuster releases that was anticipated to continue until November.
Shortly after this warning, they hired the restructuring law firm Kirkland & Ellis and the consulting group Alex Partners.
When a highly leveraged multinational company hires restructuring specialists of that specific caliber, it is a definitive, undeniable signal to the market that a comprehensive deleveraging transaction is imminent.
In the language of corporate finance, a comprehensive deleveraging transaction almost always means that the existing equity interests, the everyday shareholders who bought the stock, are virtually wiped out.
The debt is simply too large to service through operations.
Therefore, the creditors, the banks and hedge funds holding the debt, take direct control of the company's assets in exchange for forgiving that debt.
The fatal blow was confirmed in September 2022, when Cineworld formally filed for Chapter 11 bankruptcy protection in the United States Bankruptcy Court.
The reaction on the London Stock Exchange was absolute obliteration.
The shares crashed by over 80% in a single trading session.
A stock that confidently traded at pre-pandemic highs of 221 pence fell to 4.07 pence and eventually dropped down to 19 cents on the over-the-counter market.
A market capitalization that once stood proudly at £4.5 billion evaporated to just $55.88 million.
To synthesize this collapse, we must recognize that it wasn't just the external shock of COVID-19. Many companies survived COVID-19.
Cineworld's demise was a toxic, compounding chain reaction.
It started with the pre-existing, highly leveraged debt taken on to buy Regal. That $4.1 billion debt load completely eliminated their operational buffer.
They had no shock absorbers. When the systemic shock of the pandemic hit, they bled cash at an unsustainable rate.
Even when theaters finally reopened, the global supply chain of movies was broken. The delayed film slates meant they couldn't generate the necessary cash flow to catch up.
Simultaneously, macroeconomic shifts caused rising global interest rates, making the servicing of their variable rate debt even more impossibly expensive.
And finally, the billion-dollar judgment of the Cineplex lawsuit eliminated any remaining leverage or goodwill they had with their creditors.
As we conclude this autopsy, it is worth briefly noting a concurrent event that illustrates the uncompromising, deeply aggressive nature of the company's leadership.
In 2022, CEO Mookie Greidinger received a suspended 6-month jail sentence in Israel related to an anti-competitive practices case where his distribution company refused to supply films to competitors.
While this specific legal trouble in Israel is completely unrelated to the global Chapter 11 bankruptcy filing, it serves as a stark character study.
It illustrates an aggressive, unyielding corporate culture that fought for total market dominance at all costs until it ultimately hit a massive structural wall it could not bully its way through.
The culture of the organization was fundamentally built on aggressive expansion and the relentless, uncompromising pursuit of scale.
But scale built on leveraged debt is inherently fragile.
In a Chapter 11 bankruptcy, the primary objective is to keep the creditors at bay, keep the theaters operating, and restructure the balance sheet.
But the collateral damage of that process is immense.
The Greidinger family, who once owned 28% of the massive company, faced the prospect of having their equity stake entirely wiped out.
Unsecured creditors, like landlords seeking millions in back rent, or Cineplex seeking its $950 million judgment, are pushed to the back of the line, often left with pennies on the dollar.
The ultimate irony of this entire saga is that the aggressive debt strategy designed to make Cineworld the undisputed, untouchable master of the exhibition industry is exactly the mechanism that transferred ownership of the company directly to its lenders.
The empire consumed itself. They used debt to buy the world, and when the world stopped spinning, the debt swallowed them whole.
It will remain a textbook case study of financial hubris. The mechanism of their rise, highly leveraged acquisitions was the exact instrument of their destruction.
We have completed our autopsy.
Cineworld reached the absolute peak of the global cinema industry through relentless debt-fueled acquisitions, creating a $4.8 billion giant spanning 10 countries over 9,000 screens.
But they built an empire with zero tolerance for systemic disruption. They modeled for perpetual growth in a highly unpredictable world.
When the screens went dark, the legal and financial architecture collapsed inward, turning a global titan to dust.
As we look at the ruins of Cineworld, you have to ask yourself a fundamental question about modern corporate strategy.
In a globally connected digital age, where systemic shocks like pandemics, supply chain failures, and shifting consumer habits are no longer anomalies, but inevitabilities, is the traditional mega-empire, built entirely on leveraged buyouts and the assumption of perpetual physical foot traffic, fundamentally obsolete.
If scale requires lethal levels of debt, perhaps the pursuit of becoming the biggest in the world is no longer a corporate triumph.
But a death sentence.